All right, good afternoon, everybody. How are we doing today? If I can just get a quick audio and video check, let me know that you can hear me and see my screen. If you can just type it in the questions box there, just letting us know that we are good to go. You can hear me and see me, and then we will get moving here. All right, thank you. Thank you, Randall, Jason, I appreciate that. All right, well, welcome everybody to the Nadex Application and Strategy webinar series. My name is John Skelton. I'm with apexinvesting.com, and this webinar today is hosted by and brought to you by Nadex. And today we're going to be talking, it's going to be a shorter webinar today. For some of you, this might be very elementary, and you've got a good handle on this, but we know we've got some new people that are always joining us here on Nadex, and we're going to just talk a little bit about using the Nadex Strike Ladder for trade management, okay? So before we get moving forward, let's get our disclosures taken care of here. As always, trading futures, options, or any financial instrument involves risk. It may not be suitable for every investor. Any examples used today are not a recommendation to buy or sell. So for example, if I do go onto the Nadex demo platform and show you how to enter an order or whatever, that is not trading advice or recommendation. That's simply me just trying to help visualize what it is I'm teaching you or how to use the platform itself, okay? And as always, trading decisions are your sole responsibility. Past performance not indicative of future results. So speaking of Nadex, if you're brand new, if you hop on over to nadex.com, and what we're here for as far as these webinars is, I got to give Nadex a lot of credit. They give their members a lot of free education, a lot of free tools, and we're just here to help you understand who and what is Nadex, what are the products they offer, how are some ways that you can utilize the products, and just help you get a better understanding of Nadex and how they work. And basically, Nadex offers two different products. They offer binary options and spread options. You can go right here to these two different tabs, get some great information on that. Right here, you can check out, the different markets and, the contract specs. Up here, market news, great place to get some ideas of what's going on with the market, maybe help you formulate some trading ideas. Right here under trading platforms, you can go right here to the online, Nadex trading platform, or they do have a great mobile app for your Android smartphone. But right here, demo trading platform, Nadex will give you a free $25,000 demo account, and all you gotta do is just sign up for it real quick, hit open, select a username, and in just a few moments, you'll get a temporary password that will be sent to you, and you can log right in to a Nadex demo account. All right, the Nadex demo account is a great place to get familiar with Nadex, get familiar with the different instruments they offer, binaries and spreads on, the different expiration times, entering and exiting orders. It's a great place to practice any new strategies or systems that you might be testing out, as opposed to jumping in and testing those with your live money, right? You want to utilize the demo account to work out the kinks, make your mistakes, get it mastered, be profitable in demo, then move over to live. So if you don't have one of these, go ahead and hop on over right now and grab one. Just a great tool that Nadex offers and something you definitely want to take advantage of, okay? But also right here, I want to bring your attention right here to the Learning Center. If you go right here to webinars, this will show you all the upcoming webinars that are scheduled in the future. That way you could get signed up and registered, and you'll get email reminders. But if any of you are brand new or you've missed some of our recent webinars, if you go here to Webinar Archive and you go Filter by Presenter and you drop down here to Apex Investing Institute, that's us, and you can go through and catch up on any webinars you might have missed. We kind of we'll cycle back through every so often and kind of review the basics and then build on the basics and top mistakes and what to do and not to do, misconceptions, and then we'll go into picking the right binaries or spread, talk about, trading at key levels, range-bound trading, different strategies and systems. Just a huge library and wealth of information here for you, whether you're brand new or, whether you've been around for a while and you understand the basics and you want to dive into some different strategies. It's a great place for you there to check out, okay? Just a library wealth of info for you. Again, my name is John Skelton with Apex Investing. Apex and Nadex, two complete separate companies, right? Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We've got over 25,000 members. We have live trade rooms. We have strategies and systems and indicators. We have, tons of training courses, but A lot of our systems focus on risk management and probability. That's why we love the capped risk products of Nadex, and we're traders just like you. You know, we're an education partner with Nadex. We do these webinars for them, but we're traders just like you. You know, we're here to help you understand, again, who and what is Nadex, what are some ways that you can trade it, and help you understand how to manage those trades as well. So I've been with Apex now as head of operations for about 4 years. I've got a background in as a stockbroker and in the banking industry. And again, I'm a trader just like you. So today, we're going to talk about something today that seems very simple, but it's a very, very powerful tool. Okay, we're not going to dig in deep today into, you know, basics. We're not going to dig in today into complicated strategies. I want to teach you about a tool on the Nadex platform and how to use it, and you know how it can be an extremely powerful tool on any strategy or system that you are trading. So we're going to talk about the Nadex Strike Ladder and how to use that for trade management, and also how to use it for when to set your take profit orders and to understand, you know, the price and value movement of a binary. I want to talk a little bit about thinking outside of the box with binaries. We all understand the basics that at expiration, a binary is either worth 0 or 100. And I want you to think outside the box a little bit beyond that, and, you know, talk to you about, you know, utilizing binaries for, you know, shorter term moves, for directional trading instruments. Just kind of show you how this can really help you understand how to pick the best strike, no matter what system or strategy you might be trading. Okay, and like I said, we're not going to be covering the basics today. If you go to the webinar archive there that I just showed you, you can catch up on any basics there. All right. So what is the Nadex Strike Ladder? Okay. You know, what is a strike ladder chart? How do we use it? How does it help us determine some short-term directional moves and where we can potentially take profit? Well, let me pull back over the Nadex demo platform here again. And just for example, let's pull up some forex. Let's pull up euro dollar. Okay. So right here, I pulled up the euro dollar binary contracts that expire at 3 p.m. Eastern time today. Okay. Once again, anytime you see a time, whenever you see a time listed on the Nadex platform, that is in Eastern time. Okay. So right now we're about 1:04 Eastern time. These binaries just opened up and they expire at 3 p.m. Okay, so we've got about an hour and 52 minutes until expiration. So right here, each one of these, okay, each one of these lines right here, each one of these different numbers, these different strike prices, each one of these is a different binary contract. Okay, and this is what we call the strike ladder. The strike being these different numbers here. These are the strike prices. And each one of these is a binary contract. And all a binary contract is a statement, right? This statement here says the euro dollar will expire greater than 1.2330 at 3 p.m. Okay, that statement is a binary contract. And it's a simple matter of, you know, again, it's binary. It's yes, no, 0, 1, true or false. Will that happen or not? Will the euro dollar expire greater than 1.2330 at 3 p.m.? If I think yes, that is correct, I agree with that statement, then I would be looking to buy. If I think no, I think the market will expire less than that, then I would be looking to sell that particular contract or any of these other contracts. All right, so each one of these has a different strike price. You notice, for example, on these here, 23.54, 23.50, 46, there are 4 ticks or 4 pips between each one of these strikes. So this is what we call the strike ladder. All right, we can go and open up, you know, the 2 o'clocks here. The ones expire 2 o'clock. We have the same situation here, the strike ladder. So any of these, you know, indices, forex, commodities, binary expirations we pull up, we'll see a strike ladder. Now, you know, a couple things here. One of the biggest misconceptions about the strike ladder is, yes, okay, so I've got all my different strikes to choose from and contracts to choose from. Over here, the offer side, this is the price I can buy for. The bid side, this is what I can sell for. Okay, a big misconception about the strike ladder is that it's basically a catalog. It's just a menu. It's a menu of what I can order. It's just a menu list of what I can buy or sell. Okay, And even though that is somewhat the case, if it's listing out for you what options are available to you at what prices, it's so much more than just a catalog, okay? It's actually a very powerful tool. It can give you a lot of insight into, the condition of the market, the volatility of the market. It's a extremely powerful tool for managing your trade entries once you're in once you're in a trade, or should I say your exits once you're in a trade, but also helps you with entries as well, okay, to know which one of these strikes might be the best one for you. And it gives you an idea of how the move of the market can affect the value of it. What do I mean by that? Okay, well, if you're not familiar with this, you can go back and check out some of the, webinar archives. But when it comes to binaries or any options, we basically have 3 different types of options, okay, as far as the basic types. All right, we've got what's called in the money, at the money, and out of the money. Okay, well, let's take a look at something here. If we know that a binary at expiration is either worth 0 or 100, okay, you can kind of see on this strike ladder here how it goes from lower price and goes higher and higher and higher on the buy side. On the sell side, it's, going down as well, right? So what we're looking at here is just imagine a 0 up here and imagine 100 down here, okay? Because at expiration, that's what it's worth. Now, we don't have to hold a binary to expiration. We can exit early, all right? If we get in a trade, we can exit early, whether it's going in our direction and we're being profitable and we want to exit early and take some profit off the table early, or if we get in a trade and it's going against us and we're losing money at the time, well, we can exit early. All right, so we don't have to hold till expiration, but at expiration worth 0 or 100, and you kind of see the different pricing here. Okay, well, what is right in the middle between 0 and 100? Well, 50, right? So let's just say, for example, look at this strike price right here, 23.30. Okay, down here we've got 26, 34, 38, 42, 23.30. Where's the market at right now? About 23.32. It's very close to this strike price, right? And then right here, this one's 23.34. The market's at 23.32. The market right now is kind of right in between these 2 strike prices. That makes sense? And where do you see, between here and here, the market, these are priced right around $50. Okay? Because at expiration, they're worth 0 or 100. So when we've got some time left to expiration, and the market price is right around these strike prices, well, it's kind of teetering right on the fence there, right? It could go up a little bit and expire worth 100. It could go down a tick or 2 at expiration, expire worth 0. Okay, but until expiration, when it's kind of right, hovering right there, it's kind of like, hey, 50-50. We don't know if it's going to go this way or that way, right? So what about these up here? Why is this one right here priced at $85? Well, what does this statement say? This statement says the euro dollar will expire greater than 23.22. Okay, so greater than 23.22. Well, right now it's at 23.33. It's already greater. It's already 11 pips above this strike price. So this statement is true right now. All right, this binary is in the money right now. It just has to stay that way until 3 p.m. Okay, so it's a higher probability from a pricing model that this one will expire in the money because it's already in the money, correct? What about up here? Why is this one priced so low towards 0? Well, this statement says the euro dollar will be greater than 23.62. 23.62. Right now it's only at 23.32. So it would have to move up 30 pips for this statement to expire true, right? So that's a little lower probability of that happening. So that's why it's priced lower. That makes sense? So that's a lower probability of that happening, so it's priced lower. These right here at 50, meaning these strike prices are right at where the market is right now. It's kind of 50-50, right? It's kind of on the fence still till we get to expiration. These priced higher, closer to 100, are already a true statement. Now, just has to stay true until 3 p.m. So when you look at it that way, and you realize, okay, this is not simply a menu to choose from, okay? And some of you that are new, when you look at the strike ladder, it's very confusing to you. You've got all these strikes, and you're trying to look at all the buy and sell. When you open the strike ladder, first of all, find the approximate $50 area and draw an imaginary line on the chart, okay, on the ladder, and say, okay, this is where the market is right now, right? That's where the market is right now. Anything down here on the buy side is in the money. It's already a true statement, being valued closer to 100. So I've got my imaginary line around 50. Anything below this, price lower, going down towards 0. The market's not quite there yet and has to move. Okay, so it really kind of helps when you open this chart to draw that imaginary line at 50, and you kind of know, okay, these the market, has already moved past. This, the market hasn't gotten to. Now I understand a little more what's going on, okay? So it kind of shows you, an overview of the market and why they're priced the way they are, okay? But the other thing it does is this, all right? Let's just say, for example, that, okay, so right here, this strike right here is 2338, okay? And the market's at 2338, right? The market's right there. Okay, well, what if we go down to this one, 2334? Well, that means that this one, the market's already 4 ticks higher than this particular strike. That makes sense? And then if we go down from 3.4 down to 3.0, well, that means the market is 8 ticks higher than this one. Make sense? And you see that they're priced higher. So for example, if I were to buy this strike right here, the 338, and the market moved up 4 more ticks, well, that would mean that the market was 4 ticks above my current strike, okay? Just like right here, 330, the market is 4 ticks above that current strike. So what that means is if I were to buy this binary right here, and the market goes up 4 ticks, meaning, whatever the difference is between these strikes. So if I were to buy this binary right here and the market goes up 4 ticks, well, then this binary right here would then be priced the way that this one currently is. It'd be priced the way that this one right here that's currently, X ticks above the market. Or if I bought this one and the market went up 4 ticks, it would be priced where this one is currently priced at. Does that make sense? They kind of would move in the ladder. Okay, does everybody follow that? Any questions on that right there? So right now the market's at 2333. Okay, so like right here, 2330. See what that's priced at? If the market went up 4 more ticks, then this would be priced the way this one's priced at. Another 4 ticks, the way that this one's priced at. Okay, so what is that? Randall says, and if you were to sell, it'd be the same just on the, yeah, exactly. Okay, so if I was to sell this one right here for 76 and the market goes down, then this one would be priced the same way that this one is currently priced at. If it goes down another 4 ticks, it'd be priced the way this one's currently priced at. Okay, makes sense? Yeah, it's just opposite. So what does that tell us? What is another way we can use that? Well, let's just say, for example, that we were looking to buy this binary right here for $27. okay? Well, if the market moves in our direction 4 ticks, that means this one will be priced the way that this one's currently priced. And if I buy something, what do I got to do to get out of it? I've got to sell it, right? So this strike right here, if I bought it for $24.50 and the market moves up 4 ticks, it's now priced the way this one's priced at. So I could sell it for $27. So I've only got a couple dollars profit there, right? But what if I bought this and the market moved 8 ticks, which would mean 2 strikes, and I could sell it for 41. It's like, okay. So what that's telling me is if my chart, my strategy, my system, my indicators is telling me, okay, you know, the market's setting up to go long, okay? That means if I bought this one right here, okay, and the market went up 1 strike, 2 strikes, well then the one I bought for $28 would be worth, I could sell for $46. So I see my profit potential there. What if it moved 3 strikes? 1, 2, 3. I could sell it for 56 and almost double my money there. Okay? So Glenn says, is the 4 ticks a magical number? Why not 5 ticks? Does each rung in the ladder indicate a certain number of ticks, like 4 or 5? Yeah, exactly, Glenn. Because if I'm looking at this to say, okay, first of all, Glenn, you got to look right here. What is the difference between the strikes? 23.42, 23.38. So it's 4 ticks between these strikes. Right, Glenn? So what that tells me is if I buy this one and the market goes in my direction 4 ticks, then this strike would be 4 more ticks in the money and would be worth this. If it went another 4 ticks, meaning 8 ticks, then it would be priced the way this one is, and I could sell it for 40. If it went another 4 ticks, meaning 12 tick move from my original strike, then it would be worth this. Okay, so now let's switch it up though. What if I go over here to Euro Yen and I look at these 2 o'clock expirations or the 3 o'clock expirations? Okay, so if I buy for $12 and it goes down 4 ticks, what is it worth? It's not about 4 ticks, is it? 4 ticks is not a magical number. What you're looking at is, okay, if I buy this one or sell this one, what has to happen for it to be worth the next level down or next level up? Well, what are the strike differences here? 47 to 37. These are 10 ticks wide, right? Okay, or if we went to one of the indices, so it's not a magical number. It's about what is the difference between the strikes in the strike ladder. So here we'd be looking at a different scenario, right, Glenn? We'd say, okay, if I bought this one for 18 and the market moved down a strike, it'd be worth about 35. So how many ticks would it take for this $20 binary to then be worth about $40 for me to double my money? Well, it would take a 1 strike move, which is a 10 tick move. Make sense? Or if I wanted this approximate $20 binary to move and be worth $72, I would need 2 strikes of a move, which would mean 20 ticks. So on the Euro Yen, I would need 20 ticks to get a $20 binary to about 70. But if I go back to Euro Dollar, okay, well, this $20 binary, so 1, 2, 3, 4 strikes gets me to about 66 bucks. It's 4 ticks per strike, so about 16 ticks. Okay, so that makes sense. It's not about a magic number, it's about the number between here. That makes sense? So let's just say, for example, whatever strategy or system you're trading, right? Let me pull up a chart here. And there's no special indicators on this chart. We've got some bars and we've got what we call our deviation levels. These are some Apex proprietary deviation levels. Okay, these are not deviation levels that are plotted like from what previously happened in the market. These look forward, like at 8 o'clock at night. These levels right here, see this settlement, negative half a deviation, negative 0.7, negative 1 deviation. These are plotted at 8 o'clock at night for the next day. Like these are pre-plotted for me to look at. And, you know, for example, you know, these are negative 0.5, negative 7, then they go up, you know, positive 0.5, positive 7, positive 1. Anyway, not to get all deep into it, you know, but this is kind of the market putting their money where the mouth is. They're forward looking based on the pricing and IV of options for the next day about the expected moves of the market. And a +1 or -1, a 1 deviation move of the market, you know, is about, you know, close to an 80% maximum move. You know, 80% of the time the market's not going to go past 1 deviation. You know, and you can actually kind of see that here. I mean, just looking at this dollar-yen chart right here. You know, a few days ago, okay, the market's moving around, it's right here at settlement, and, you know, comes up, where does it come to? 1 deviation. It barely comes past it, gets rejected, comes back down. And where does it come down to? Boom, right here, this 0.7 deviation, like right at it. Comes back up to test that 1 dev and goes, okay? What about the next day here? What does it do? It comes down, again, these are pre-plotted the night before. Comes right down like to the tick to this -1 deviation level, bounces up to where? Half deviation level, comes back down to what? 1 deviation level, bounces off. See how powerful these are? And these are pre-printed, like, you know, today. You know, it's right here around settlement would open up, obviously, comes right up here, gets a little past the deviation level, gets a little fight there, gets rejected and comes down, okay? So whatever strategy or system you're using, you know, but just for example, even these basic deviation levels, okay? Let's just say, for example, that yesterday, market came down here, bounced to the tick off this deviation level, came back up to this deviation level. And let's say right here as it's reversing, you know, on my strategy or system, whatever I'm using, let's say I had an indication to go short. But the market was going down. Well, so I had this bar close down, I had this bar close down. Let's say at the close of this bar, for example, I had some indication on my other strategy or system to go short. Okay? Or, you know, so where's my target? Where's my goal? Should I choose a binary that needs, you know, 100 ticks of movement to profit for me? Well, if I'm entering right here to go short, should I have a profit target that's like way down here? Like somewhere way down here? Should I have an expectation of movement like way down here somewhere? Like I'm gonna go short right here and I want it to fly way down here. Well, maybe it will, right? Because it can happen. But where should be my target? Where should I expect the market to go to? And where should I expect that there might be a rejection? Well, clearly back to this 1 deviation level, right? That's kind of my first target or where I want to plan for it to go because I see how often it's rejected or hesitation at those levels. Does that make sense? So whether, you know, you're using these deviation levels or support and resistance level, whatever level it might be. So what I want to know is, okay, well, if I had a trade to go short right here, what's that price over to the right here? So I'd be going short about 106.81. The deviation level is 106.68. So how many ticks is that? How many pips is that? About 13, right? So, okay, I have an indication to go short right here. I can see a potential stop or bounce or reversal or chop at this level. So I've got 13 ticks of movement, right? Before I expect something to happen. So if I've got an expectation or a potential target of 13 ticks. Can I be profitable in 13 ticks? All right, well, let me pull up dollar yen and let me take a look and see, okay, that's realistic to have that target or have that level in mind. And so let's just see what would happen. So I've got 13 ticks. I see that these strikes are 4 ticks apart. So that's a little over 3 strikes. So if I were to sell this binary right here for $71, and why don't, so 13 ticks, 3 of these strikes would be 12 ticks. So let me see what would happen. If I sold it for 72 and the market did go down to that deviation level, that means I got 4 ticks, 8 ticks, about 12 ticks, okay? And I could buy it back for 33. So I sell for 73, buy back at 33. I've got about a $40 potential profit, okay? And my risk is about 30 bucks. So, okay, I like that. I can do that, right? So maybe I would sell it, perhaps, as just a scenario, sell it for, about a $30 risk. And I'd look to, be buying it back when it's down to about $35 to make 40 bucks on it. Okay? It's like, okay, I like that. I like my potential return there. Okay? Now, let's look at a different example here. Let's say that we were looking at the US Tech 100. Okay? And let's look at the Dow real quick here. Okay, so what are the difference in the strikes here? 429 to 441. So these are 12 ticks between each strike. That makes sense? Okay, so if I were to, let's say that same chart scenario. Let's say that same chart scenario right here. Okay, this is dollar yen, but let's say this same chart scenario was on the Dow. So I was looking at, okay, I've got an entry here, but that's a strong level it's been bouncing off of. I got 13 ticks. So, which is basically about 12 ticks, which is basically 1 strike, right? So if I can sell it at 37, if it goes up, if it goes in my direction, I move a strike. Oh, wow, I don't really have any room to profit there, do I? Not a whole lot, right? I mean, if I sell it for this one for 77 and it moves the whole strike, I can buy it back for like, 75 to 60. I've only got about $10 of profit in that move for this particular scenario, because of the volatility and pricing of this market. So would I maybe not be as open to taking that particular trade? Does that make sense? To where if I'm only, expecting that kind of move till I hit a level, would I really want to trade it if it was on this particular market? Like sell it around 80 and buy it back at like just $5. Yeah, that's probably not worth the risk or the trade, right? On that particular market. Okay. But again, if it was on this market, which had smaller strikes and different moves there, I might want to go ahead and do that, right? If I was to be looking for a trade on the Dow with those bigger strikes, I might want to only take a setup that has a further chance of moving, right? Where my level is further away, so where I could sell something at 76 and let it go several strikes and buy it back at 20, make 50 bucks potential. Does that make sense, guys? Just that little lesson right there, how this strike ladder is a lot more than just a menu, okay? Where it's not just a menu, it's really looking to see, you know, if the market moves. You know, what if I'm a breakout trader and I want to trade a breakout directionally? I don't know that the market's going to keep going and going and going and going, but I expect it to make a good quick move. So on a good quick move, you know, if I buy this one at 36, you know, with a nice little move, will it get up to being worth 70 or 80? Okay, great. If I bought this one right here at $8 and the market made a quick little move and a couple strikes, oh, that's not worth much right there, is it? Like to buy one of these cheap ones and it moved 2 or 3 strikes. I don't really make much. You know, if I buy this one and it moves a few strikes, okay, I can make something, right? But if I buy the $65 one and it moves a strike or two, I make a little, but I make a lot more, you know, with a move of one of these in the middle. So it kind of helps me see the best binary option. Not only does it help me, you know, see the best one or the one that would move the most, but it gives me a perspective of, okay, if the market moves X many ticks, it will be worth this much and I could get out. So what is the probability of the market moving that much? Am I coming up to any support or resistance levels or deviation levels or, you know, highs or lows of the day? Do I really want to risk it going past that? You know, if I'm taking this trade short and it's coming down to this one deviation level, which I, you know, see it popping off of, and I see the market start to hesitate right here, do I want to just hold that binary to expiration and let it come back and go against me and be worth 0? Or would I much prefer to say, okay, you know, I got in down here like 35 and it moved a couple ticks. Now it's worth, you know, 70 or 80. I want to go ahead and just take that $50 profit off the table instead of risking that market reversing like that. Right? Does that make sense? Grab the green and go. Yeah. Okay. Randall, are the strikes tighter depending on what time frame you choose? Yeah, Randall, the strikes can be tighter depending on the time frame. You know, like 20-minute binaries on the indices are going to be smaller than the hourlies. In the intradays, you know, the hourly is going to be tighter than the dailies. The dailies are going to be tighter than the weeklies. Okay, because there's longer time to expiration, so there's more chance of a bigger move, so wider strikes. Okay. Glenn, does the larger the gap between the strike prices indicate smaller profit potential, and conversely, if the gap is smaller in the number of ticks indicating? Okay, Glenn, I think your question is if the gaps between the strikes are smaller, like right here, it's 2 ticks, okay, or 4 ticks, is there a greater profit potential than in markets that have like a 10-tick gap? Is that what you're asking? Not always, Glenn. Okay, it all really depends with the movement of the market. For example, let's go here to forex pound yen, and let's see here. So how wide are these, Glenn? These are 10 ticks, right? So bigger than the 4 ticks. But look at this. Buy for 20, sell for 57. Just one strike has you know, from 25 to 60. Okay, back over here on these 4-tick wide ones. All right, we go from like, let's look here. You know, from about 23 to 23, or 2 strikes would be 23 to 38. 3 strikes would be 22 to 52. Okay, so it takes 3 strikes, so about 12 ticks for what this other one does in 10 ticks. Okay, so a lot of it has to do with how wide are the strikes. That's one thing. For 2, the volatility of that market. Is that market moving a lot? Is there news reports coming out so the prices are a little tighter? How long to expiration? You know, the width of the strikes compared to, you know, how much does the market move? Okay. So yeah, there are several factors there, but the point is, you know, this strike ladder really tells you a lot more than just being a menu. I mean, do you see that with just a quick little 30-minute webinar even? That it can tell you which binaries, are going to move the fastest for you. It can tell you based on a certain move of the market what the pricing will be. Okay, but also the other thing is this. If I bought this binary for $42, the market goes up a strike, it's worth 51. I can sell it for 51. Another one I can sell it for 63. Another one I can sell it for 75. 4 more ticks I can sell it for 86. I've made a pretty good profit there, right? But then the market moves 4 more ticks, I make like $1.50. 4 more ticks, I make like 75 cents. 4 more ticks, okay. Now with the moves of the market, and look, then I get into like the 92 range. It keeps going and going and going. I'm not going to make any more money with the market moving unless I hold it to expiration. And what do I risk holding it? Another hour and 19 minutes. Could the market go the other way in the next hour and 19 minutes? Yeah. I think all of us have seen a market completely turn around in an hour and 19 minutes, right? So if I bought this thing for like 35 bucks, and then it, and it keeps moving up, and it's like, 44, 57, 68, 79, 87. I just made 50 bucks profit if I get out right here. Is it worth me holding another hour and 20 minutes just to try to get another, $13 at expiration and risk the whole thing going against me? Especially if I get up here into like 89 or 92, then it just doesn't move much into expiration. Should I? Okay, because I'm going to be greedy and I want to make another $8 holding it for an hour and 20 minutes and risking it going the other way. Does that make any sense at all? Is that smart to do? Because you're going to risk giving back your $60 profit because you want to be greedy and get another $8. No, close it out and go on to the next trade. So what's the other thing that this strike ladder just did for you? It showed you where the price moves fast and it's worth staying in, then where it's like, okay, it's slowing down here. You're not going to make hardly any more money with the market moving another 4 ticks and 8 ticks and 12 and 16 and 20 and 24 and 30. Why hold on to it in here? You can exit early, take your profit off the table, and go. Go on to the next one where you could, buy for 20, 30 bucks and, maybe get it to be, 50, 60, 70, 80 and take your profit and move on to the next one. That makes sense? So this strike ladder shows you a lot. Shows you the ones that move the fastest, an idea of what it will be worth, and where it slows down and may not be worth staying in that trade any longer, and get out of there. Especially if if the market moved and it's up in this area at like 88, 89, where it stops moving much, and that same area happens to be right at a deviation level or support and resistance level, does it make absolutely any sense at all to wait another hour and 20 minutes and hold on to it for another 10 bucks? No, because you've come down to a level of resistance, a level of a potential reversal. You've made most of your move. Get out. Okay, that makes sense? Okay. So real quick, Byron says, how do you exit early? Okay, well, Byron, let me just show you here. So this is the Nadex demo account, okay? So I'm just simply showing you how to do this on the platform. This is not a recommendation or a trading advice. So Byron, let's just say, for example, that I wanted to buy this one right here, this euro dollar 12230, right? Let's say I thought the market was going up and I want to buy this one. Okay, so I'm going to click it. It opens up the ticket. It's marked buy, right? So I want to buy it. And it says limit order here. I'm just going to put this in as a market order. It Size, I want to do one contract. Okay. Let's see here. Hold on just a second here. Let me refresh this. Give me just a second. Forex binaries. Hold on, I gotta refresh my screen here. Okay, sorry. Okay. So if I want to buy this, see, it says max loss 64.25 because that's, you know, about what the market was at here. And my max profit would be about 34 bucks, you know, the difference of 100, right? So I want to place the order. And okay, so I bought this contract, right? I placed the order. It's in my open positions right here. See that contract there, Byron? And so I bought it, and the average price, meaning the price I had paid for it, was $63. And I bought it. See, it says +1. Okay, that means I bought it. All right, so if I want to get out of something I bought, what do I have to do? I have to sell it, right? Okay, well, let's look at something here, Byron. The strike I bought was this one right here, 2330. You see it? So if I look back up here in the ladder at 2330, right now, people can still buy that one at 63, or they can sell it at what? 58.75. So, or 58, 57.50, 57.75. See the price changing? Notice right here it says current market. This number right here, see it? Matches this number. Well, where'd it go? Right there. See it? The sell side, 58.25, 58.75. See that? So I bought it for 63. Right now, I can currently sell it for 58.75. So 63 minus whatever this number is right here is my current profit and loss. Does that make sense, Byron? That's how they figure this profit and loss, because you paid this for it. Whatever you can currently sell it for is what it's worth, right? So let's say I bought it for 63 and the market does go up, you know, and the market's going in my favor, the market's going up, and, you know, so it goes up a little bit. Now it's worth 68. Now, and it goes a little more. Now it's worth 78. Now it's worth 87. So let's say I bought it, it's going in my direction, I'm in profit, and I want to exit early, right? Or let's say I bought it and the market's going against me. Now, you know, I bought it for around 63. Now it's only worth 56. And the market's going down, it's only worth 42. The market's going down, it's only worth 25. So it's going against me, but I don't want to hold it and let it go all the way against me and be worth 0. Because I say, oh, I must have been wrong on this one. Let me get out. So I can hold it till expiration and let it expire being worth 0 or 100. Or I can exit early to lock in some profit, or I can exit early to limit my loss. Okay, makes sense? So remember, I bought it. For me to get out of it, I have to sell it. So how do I do that, Byron? Well, see right here in my open positions, see the contract? All I got to do is click on that. It automatically opens up a ticket, and look, see the red here? The ticket is automatically already marked as a sell, because the system knows, hey, you've got an open position that you bought. +1 means you bought. So if you're clicking this to get out of it, we know that means you want to sell it, because that's the only thing you can do to get out of it, right? Okay, so if I want to sell it, and I want to sell it for, you know, the current price right here that I can, you know, that it's priced at, I just hit place order. And see, it's gone. Does that make sense? If we were doing the opposite, and let's say that I had sold a contract, let's say I'd sold this one right here, okay? You know, so I want to sell it. I'm using market orders for this to make them go in right away. So if I sold an order, sold a strike. It's in my open positions here again, right? And what does it say now? -1, because I sold. Remember when I bought it said +1? Okay, so I sold it. So now if I want to exit that early, okay, I have to buy it back, as it were. So I just have to click my open position. It automatically opens a ticket marked buy. You see that? Because it knows that's the way I got to get out. And I placed the order and boom, it took me out. Okay. So the difference of the, the profit or the loss and fee, it's put back in my account. So that's how you exit early. Okay, guys. Well, I hope this, short webinar really helped you understand that the price ladder is a lot more than just a menu. It's a huge tool to help you manage your trade, help you, pick the best binary, potential binary for your strategy or for your expected move. And also for your X's to see, where the value increases are going to start to slow down. So you may want to, consider exiting early as opposed to holding to expiration. You have to look at the probabilities, put all the probabilities in your favor, and it really helps you piece that together. Okay. All right, Randall, I'm glad to hear that. Randall says, thank you. This presentation completely changed how I approach each contract. Well, Randall, I'm going to take a wild guess and say that if you're new to binaries, you are looking at these cheapest ones you can up here because you like being able to say, I want to risk $7 to potentially make 92. I like that, right? Instead of realizing, oh, man, the market moves 4 ticks. I'm down, or 4 ticks, I'm down, or 4 ticks, or 4 ticks, you know what I mean? Well, I mean, when you were new, that's probably what you were doing, right? Because that's what we all did when we were new, yeah? And then you start to realize, oh, okay, I need to see where they really start to move. And then I really need to look at the distance in the strikes compared to that value, and do I have that expected move on my chart? Then I need to see when it slows down, and that really helps me manage my entries and exits. Okay. All right, guys. So thank you so much for your time today. I appreciate you joining us, and make sure to hop on over to nadex.com, get signed up for any of the future upcoming webinars, and we will take it from there. Colby says, great presentation. This changed my perspective of how I view the strike ladder and how to utilize. Absolutely, Colby. Again, it's not just a menu list, right? It's a powerful management tool to really see inside and really help you out. So check it out, try it out. Make sure to take advantage of your demo account, and have a great afternoon and weekend. We will see you on the next webinar. James says, where there'll be a replay. James, if you go over to nadex.com, okay, right here under Learning Center, Webinar Archives, this is where webinar recordings are right here, okay? And you can go and filter by presenter and find us right here, Apex Investing, okay? You can go check out, previous webinars. But also, since you were on this webinar, you'll automatically get an email with the link to the recording as well if you had registered for this webinar, okay? All right, guys, thank you so much. I appreciate your questions and your feedback. Have a great one, and we will see you on the next webinar. Take care. Thank you.